Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest. That's going to be Andy Swan. He's the co-founder of LikeFolio. Welcome back to the show, Andy.
Thank you.
All right. So, we hadn't talked Deckers in a while, and I looked at this chart from those January all-time highs. The stock was trading $224. I mean, this has just been slumping down another 3% today ahead of earnings. Do you guys have the data that backs up this horrible move to the downside?
Yeah, it's just it looks like a recalibration of the company's prospects. I think it's probably now we feel like everything's in line with reality. And, Deckers, they're doing a very good job with Gen Z. They have a really strong alignment with that younger generation and also with performance-focused consumers. A lot of people are abandoning the legacy brands like Nike and Adidas in favor of technically superior and authentic labels like Hoka and Uggs that Deckers owns. But it's not happening as quickly as Wall Street might have previously thought in January. And when we look at the data, it's kind of fine. You see Hoka and OnCloud are gaining in visits to the websites year over year, showing that customers are really checking out these brands, and Nike and Crocs really falling off. But it's not happening at an accelerating pace. It's not happening in an overwhelming way. And we've seen this, pretty consistently. The web traffic for Deckers has pretty closely tracked the stock price, and you can just see that it's just kind of faded. And we're seeing lower highs in terms of the brand influence, but a pretty stable base. And I think at this point you just have to say we have to wait and see what's next. Fairly priced. It's a good company with a good foothold in the younger generation, but we're not seeing signs of a big reacceleration. We're seeing steady growth in a tough macro environment that's pulling competitors down worse than it's pulling.
Something more theoretical. Uggs do a great job. They're a mature brand, cash flow generation. Hokas are growing nice, profitable, growing, doing a great job. A lot of what I read about is their effort, and especially in Hoka, to go to direct-to-consumer. And they think when they get to 50-50 direct-to-consumer, 50%, that it'll really unleash their margins. Now, my question to you is, this is not the first time we've talked about a shoe company going to direct-to-consumer. Nike tried it, thought it was the basis of their game plan going forward, and then had to almost abandon it. That's a big plan for Hoka.
Yeah, I would say that the benefit that Deckers and especially Hoka has that Nike did not is that they have some humility and they understand who they are, and they understand that they can't just overnight force their customers to change how they buy from them. And I think they're doing a very good job of taking it slow, shifting that consumer base from retail outlets to direct to consumer. I think they're doing a very good job with that because of the engagement that they have through social media and other channels with the younger generation. Nike, when they tried to do that, they really kind of pulled the rug. If you remember what happened to Foot Locker at that time when they made those announcements, it was like they pulled the rug out from under their retail partners very quickly and were very abrupt and really pretty arrogant about the way that they went about it. I don't see that coming out of Deckers time soon. I think they're doing it in a much more natural way, much like how Walmart shifted from brick and mortar to then the online channel growing at a very steady pace until it got to where they wanted it. So I see them achieving the goal. They may not achieve it as quickly as Wall Street wants, but I think that they're doing a very good job of maintaining their authenticity with their audience as they do it, and maintaining the relationships that they have with their retailers as they do it, not isolating anybody, not throwing anybody under the bus as they try to make a bold move. So I like their approach to it a lot.
about 53% from those all-time highs right now. I mean, when you guys look at an earnings score on this one, is it positive? Because, I mean, I get the run-up that we saw through 2024. They were just beating every expectation across all their brands. But right now, you said it's, maybe a little semblance of reality here. Are you guys positive on this one going into the report?
No, we're not positive. I would be positive if we hadn't seen these first 2 weeks of earnings season where you had, Netflix put up pretty good numbers and fell pretty hard. Chipotle's numbers were not nearly as bad as Wall Street's reacting, and also Tesla's numbers initially up but then sold off. It's almost like a sell-first market right now on these earnings reports, and so we would be a little bit positive and say that the stock is oversold here and the company looks pretty good and looking for a little bit of a bounce on earnings. But because of the way the earnings market has reacted these first couple of weeks, I think it's better to stay on the sidelines, stay neutral, and see if you get an opportunity down the road with more data, more understanding of how the company's doing, and maybe even a better stock price.
Yeah, maybe they need Sydney Sweeney to do commercials.
At this point.
That's right.
Look at American. Go viral.
Yeah, look at American Eagle today, up over 3.5% on the back of that. All right, great stuff. Great data, Andy. Appreciate it.
Thank you.
All right, that's Andy Swan, co-founder of LikeFolio, breaking down Deckers Outdoors. Kevin, this is just a pretty ugly chart. I mean,